makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. A nervous wait for the latest U.S. jobs data and potential signs of further cooling in the labor market. We'll discuss what it means for monetary easing and whether bets on Fed cuts have gone too far. EU finance ministers are scrambling to find an agreement on new fiscal rules for the bloc. The economy commissioner, Paolo Gentiloni, says an agreement can be reached in coming days. Plus, more of our exclusive interview with the Prime Minister of Palestine, the Palestinian Prime Minister, who says a Palestinian Authority is working with U.S. officials on a plan to run Gaza after the war is over. Now let's take a look at the European markets map. So as we look, of course, into the weekend, a lot of focus not only on treasuries, but a lot of focus on what we saw yen do on the back of BOJ speculation. Now, stocks are steady. I guess some are saying it's not a technical term, but they could be a little bit nervy, waiting for that U.S. jobs data. Again, I think a lot of market traders are waiting or not for some evidence on whether the labor market is cooling fast enough then for the Fed to be closer to reducing interest rates. That's really what the markets want to know. So for more on the markets, I'm delighted to be joined by Christian Keller, head of economics research at Barclays, but also with us here in the studio, Gina Martin-Adams, chief equity strategist at Bloomberg Intelligence. So Christian, great to see you. So good to have you as well here in the studio. Gina, talk to me a little bit about, if you look at equities, if you look at what's pricing, it's still a lot of, will they cut? Yeah. When they cut and how much will they cut? Do you believe that the Fed is there yet next year?
Oh, it's such a tough question right now. And I think this is what, like you suggested, the market is a bit angsty about tomorrow because it is the one cog that seems to be holding up so well is the employment situation. When we look at the leading economic indicators index, it's just completely crashed. It's down more than 7% year over year. It's never been that low in a non-recessionary environment. It started crashing in late 2022, and yet employment still seems to be hanging on. So it's been this very long wait for employment to start to capitulate to weaker economic data, and yet it's not. And so this is the conundrum where we now have that wonderful disinflation. We are starting to see earnings stabilize a little bit, reflecting that disinflationary landscape that emerged in 2023. But will we get the Fed cuts, or will we have to contend with higher for longer interest rates in 2024 is still a huge question mark in the equity markets. And certainly everyone is very confused. No one believes that the earnings stream can recover. So we're much more dependent upon the Fed to sort of ease our concerns to get that upward momentum emerging in the equity market again. Yeah.
So Christian, how do you expect it to play out? And again, as Gina says, it's just very difficult to read because there's also belief in the markets every 6 months that something will collapse and then everything's repriced as, we have economic data that actually shows stabilization.
I think there's a bit of a disconnect between most of the economists, academics, even I've read recently, who think that generally a lot of the disinflation that we've seen, and it was great disinflation so far, a lot of this has come from goods. And that was a supply side effect, supply side improved, all the supply side chains in a way, that trouble is over. What we need for the so-called last mile now is, however, a little bit help from demand. Core services, the super core measure that the Fed talks about, is still quite strong. And we are more on the conservative side. We think that actually that could get a bit more sticky. Admittedly, the recent data was good. We see what the labor market data brings today. We actually think the labor market is still quite robust. And so, if we get told today that actually it's much weaker than we thought, we may have to adjust a bit. But we think the market went way ahead with regard to the rates cuts, its pricing. And I also think what's interesting is the equity market seems to be hoping for lower rates to support the equity valuations. But some of the fixed income investors, they seem to be buying bonds because they believe there's going to be a recession. So you cannot have both, because if you have a recession, the equity market doesn't seem to be pricing in an earnings recession, while the bond market is somehow, just pricing the lower rates. And even if it's a recession, I think that's okay with us. That's good for bonds. And I think we have again a situation whereby the two markets seem to be looking at different scenarios, or they're looking at a very narrow scenario where everything falls together, Goldilocks, where we have continued growth, but inflation just comes down to 2 without anything.
But Christian, first of all, we spoke to Bill Dudley. Here is what he said on Fed 2024.
I think they're going to be a little slower to cut rates than what the market expects. And I think the reason for that is they want to be highly confident. Those are Powell's own words, that they're going to actually get inflation back down to 2%. So to be highly confident, they need more than a couple months data showing progress on the labor market getting a little looser, wages coming down, and especially service sector inflation becoming less intense. So I think they'll cut rates in 2024, but not as much as the 100 basis points of rate cuts that are currently penciled in.
Christian, I said like Fed 2024, like if it was running for office. It's not. But talk to me about your base case for inflation. You believe that inflation, U.S. inflation, could actually be a little bit more stubborn than the market's pricing in.
Yeah, but when we look at the PCE core inflation, without getting too technical, but that is of course a term in a way the Fed supposedly looks at, and we see that closer to 3, I think 2.8 or so, a point estimate for the end of the year. But we're seeing that with the Fed staying on hold until the final month of the year, December, that is. And we see, a U.S. economy that during the course of the year, slows significantly, doesn't fall into recession, but also comes down significantly from the pace that it is at now still. And that scenario is certainly not what market is pricing. And again, people like Dudley, central bankers, they talk similarly, that you want to be confident. But markets seem to be more, in a way, optimistic on the rate cuts. I think politics may play a role. Some people believe if the Fed doesn't cut until June, July, then they may have to wait until December, but they probably want to do it earlier to avoid the risk of a recession. So markets believe the Fed is much more cautious on not wanting a recession, while most observers like us believe they're more cautious on getting inflation really down to 2%.
And Gina, I love your research. So you have this like data-driven research, and I think you put like most important charts of the week. And I know this week you spent quite a lot of time looking at liquidity. So when you look at some of the indicators that give us a sense of where earnings per share go, what are you looking at outside of kind of what everyone else is looking at? Yeah,
I think this is a great question because there's so many different things that are running around the market, and all of them are with respect to the Fed. And the latest sort of rumors, if you will, that have been floating around in the market is that the equity market is only trading on liquidity. And what's happening with the balance sheet and with Fed changes in liquidity is what really matters for the equity market. And while I do think liquidity is a portion of the story, I think earnings are really important to follow. And frankly, I disagree with the notion that the equity market is not priced for recession. I think the equity market is absolutely priced for recession. There are 7 stocks in the equity market that are not priced for recession because they've experienced a miraculous earnings recovery related to AI and capital spending. But when you look at things like small caps, for instance, small caps have been in one of the worst bear markets in U.S. history, second worst in 40 years. And small caps are trading at enormous discounts. So the small cap index would tell you that the equity market is very prepared for recession and also priced for it to continue. When we run our models, we use things like macro indicators like the unemployment rate, durable goods orders, commodity prices, as well as interest rates. And that tells us that the equity market is anticipating 0% growth in earnings over the next 12 months. And I think that the sort of popular ways to look at the equity market are simply look at the broad valuation ratio, look at what the consensus is expecting for earnings. But that's not always what's really priced. I think we need to dissect the index pretty carefully. And frankly, I do think that there's a lot of potential upside if the economy comes in a little bit better than anticipated, if companies can manage to produce earnings growth. As has been the case throughout 2023, companies have been beating expectations, which were very, very low. I don't think there is any expectation of a miraculous earnings recovery embedded in equity prices. So as we go back and forth on what's the Fed going to do, how's liquidity shifting, how is that going to impact valuations, it's still important to keep your eye on that earnings stream because it could surprise us in 24. And I want to ask you also about private markets and actually some of the analysis that you've done around that. But we also have the German finance minister, Minister Lindner, talking about the fiscal rules. Now, Germany really at the forefront. He's being doorstep and he's arriving at the council meeting. We're just waiting for him to maybe give us more of a sense of how the constitutional court in German ruling changes the way that they can spend going forward and whether it's really holding them back. So I know also Christian Keller is 100% on top of that. German France, he says, is at a 92% agreement on fiscal rules. I mean, 92%, we're nearly there. So it's not a done deal, but we're nearly there. Minister Lindner also saying that he's still concerned about corrective elements of rules. So let's, first of all,
of all, Christian, let me come to you on how you're expecting some of the fiscal pacts that were really forgotten during COVID era to come back. How limited also is, because of that court ruling, Germany on how they spend money going forward, and how much of a headache is that?
You said I'm 100% on top of this. I think no one is 100% on top of this. Frankly, I don't think the German government...
You're 110% on top of it.
I don't think the German government does know exactly what they want to do at the moment. But, you know, the headline number, 60 billion, is, of course, one over several years. And so what it comes down to is 23, 24. 23, they seem to have solved now by declaring another year of emergency. And then it leaves 24. And there, it seems to be a number somewhere between 15 and 20 billion. You know, 17 billion, I think, is a number that the finance minister himself mentioned. Now, that is in principle doable. So we actually think the macro implications for 24 are limited. And a lot of people were concerned whether this is now what really drives Germany into a proper recession. You know, the question is how they overcome these 17 billion. You know, will they start cutting some of the additional social spending they were planning? You know, there was a lot of additional spending they were planning for the budget for 24, or, you know, will they cut some of that? And, you know, another question is how they will solve the longer term issue. And, you know, for that, they would need a 2/3 majority either way. Either they trying to change the debt rate, or they try to establish another fund the way they did with the defense fund, but even, you know, for climate. But even for that, they need a 2/3 majority. So it will be politically very difficult. And I think Germany has now to take a few difficult decisions. That's why I think the outcome is still very unclear. But 2024, we don't think it will be a massive macro impact.
Thank you so much, Christian. And Gina, just to finish us off in terms of maybe some of the sectors that you like. I mean, I could speak to you for like a million years on just some of the great charts that you had this week. You look at like proprietary indexes to really show us or try and figure out where we go next.
Yeah.
But do you have a breakdown of what could outperform the rest?
Yeah, so from a sector perspective, our U.S. sector scorecard, both large cap and small cap sector scorecards, have recently highlighted financials, which, you know, really is unexpected and certainly creates a lot of uncertainty. Investors can't stand this space. They're very scared of the banks. So we spent a lot of time really talking about financials and what could spark recovery there after 2 years of really poor performance in that group. And it really is about the yield curve and how prepared banks are for a potential crisis emerging. We looked at things like loan loss reserves, which large cap banks have actually built up about half of the loan loss reserves that they had for the COVID crisis. So they're relatively prepared for a pretty significant economic meltdown. About half as bad as COVID would be still a very severe economic recession experience. So that's something to certainly watch, as well as the yield curve recovery. And then I'd go to regional strategy as well, because we did update our global scorecard. Unfortunately, it's not great news for Europe, which still sits toward the bottom of our global scorecard in developed markets. But it is still pointing to emerging markets as an opportunity for 2024. And I think that surprises some risk-intolerant investors out there.
Christian's outraged. Gina, thank you so much. Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. Christian Keller from Barclays stays with us. We'll talk a little bit more about the dynamics between China and the EU. Coming up, can European finance ministers strike a deal before the end of the year? We'll return to Brussels next, and this is Bloomberg. Welcome back. European Union finance ministers are making progress on an agreement on new fiscal rules for the bloc. Now, officials held talks well into the early hours in Brussels. Now, the French economy minister, Bruno Le Maire, says he is pushing for a deal before the end of the year.
We made progress, and I really think that on the 5 remaining %, we can find an agreement by the end of this year. It requires a lot of work. We stand ready to work very hard to get an agreement by the end of 2023.
We're almost there. Last night it was not possible to finalize all the pending consultations of a technical, a political, also a legal nature. But we hope to be finalizing this in the coming days. And if necessary, we would convene an extraordinary ECOFIN.
Well, just minutes ago, also, that breaking news, the EU finance ministers have picked Nadia Calvino, who you were just seeing in that clip for the top EIB job. So we'll see exactly where that brings us. She had spoken in the past about some of the things that she'd like to focus on and push on. Now, for more on all of this, let's bring in Maria Tadeo, Bloomberg's Europe correspondent in Brussels. So, Maria, where are we now?
Yes, Francine, good morning and good to see you. On Nadia Calvino, just very quickly. This was a job that we know the Spanish government wanted. They lobbied really hard to get her this job. It would mean now that she would exit the Spanish government. And of course, that means that she will no longer be the finance minister of the country. So that is the significance of it. And it also means that Margaret Vestager, remember, she was the star commissioner for many, many years, has lost that job. And there's now very serious questions about the political future of Margaret Vestager. Many would say her political star has now faded. Now, in terms of the meeting today in question, as you say, Francine, there was a Eurogroup meeting. It ended at 3 a.m. in the morning. So we're back to this fiscal debate, and it really underlines that fiscal rules, but also economic governance, is back at the forefront of European policy making. Now, as you say, Francine, there is no deal yet, but this morning there is an optimistic tone that there will be a reform of the debt and deficit benchmarks. Remember, this is a 60% debt to GDP and the 3% of European economic governance. What we are being told is that there is a new proposal that has been agreed by the Germans, the Italians, the Spanish, and the French, and that we're now almost 95% there. Remember, this matters because the European Central Bank has said they want to get this reform done before the end of the year. They want to send a clear signal to markets that they are serious about fiscal discipline, but also there was a serious question too about the growth prospects and the investment. So we are told no deal for the time being, but one is expected to happen before the end of the year.
Thank you so much, Maria Tadeo there in Brussels, of course, following the proceedings. Now let's bring back Christian Keller, Managing Director of Economics Research at Barclays. Christian, where does Europe sit right now? I mean, I was making fun of you that you disagreed with Gina, what she was saying, which I know is not true. Europe has many challenges ahead.
Yeah, I mean, first of all, very quickly on the fiscal rules, I think as messy as it is, it's actually showing now that it's a good thing that Europe has some kind of a fiscal anchor. If you see what's going on the other side of the Atlantic in the US, where markets are getting a bit concerned that, the US is running huge deficits, which, no one really seems to have a plan to bring them back. But back to Europe. Europe has been stagnating for 2 years almost, and we don't see much change. Recent data suggests that Germany actually is probably in recession now, with the fourth quarter likely to be negative growth. At the same time, with inflation coming down, wages having grown quite rapidly, so you should have a real income increase next year, which we think will avoid a really deep recession. So what we actually expect is slow growth next year, but on a sequential basis, probably improving during the year. So, not a very exciting outlook, but probably with also limited tail risks.
Christian, thank you. Christian Keller there, Managing Director and Head of Economics Research at Barclays. Coming up, the yen struggling for direction as focus shifts to today's crucial U.S. jobs report. We'll discuss what this means for both the Fed and the BOJ next. And this is Bloomberg. So the yen struggling for direction after yesterday's surge. That's as the focus shifts from speculation of a near-term policy move by the Bank of Japan to U.S. jobs data a little bit later today. Now joining us now, Bloomberg MLive strategist Ven Ram. Ven, great to speak to you. I love the fact that now, because of the wild swings, we have a lot of people telling us the yen is just too tricky to trade. Where do you see it going?
Morning, Francine. I think that the yen is definite upside in the short term because there's lots of speculation that the BOJ will do something next. The meeting is live. I don't think that the BOJ is prepared to move just yet. The noise that we have heard from the BOJ this week is all about the preparatory groundwork needed for them to do something eventually. When is that eventually going to come is probably in spring, if you ask me, because that's when the labor negotiations will take place. So, and they need confirmation that there are wage pressures that are sustainable. So, and therefore, I think that this, in the short term, in the run up to the meeting next week, I think the yen has definite upside. But as soon as the markets realize that nothing is going to come after next week's meeting, I think there will be short-term profit taking. But in the run-up to the spring, I think that the yen has definite buoyancy.
Ven, thank you. I know we'll get back to Ven, of course, with more analysis. Option traders also saying that investors were left a little bit, confused and unsure following this roller coaster ride. Some saying that the markets may be headed into a dollar bear trap this evening if the U.S. payrolls data surprise on the strong side. As always, our Ven Ram there with the latest. Now, coming up, the Palestinian Authority says it is working with U.S. officials on a plan to run Gaza after the ongoing war is over. The Prime Minister adds that Israel's aim to fully defeat Hamas is unrealistic. Our exclusive interview, Mohammed Shtayyeh, that's coming up shortly, and this is Bloomberg. A nervous wait for the latest U.S. jobs data and potential signs of further cooling in the labor market. We discuss what it means for monetary easing and whether bets on Fed cuts have actually gone too far. The Spanish Finance Minister Nadia Calvino is picked for the top job at the European Investment Bank as EU finance ministers scramble to find an agreement on new fiscal rules for the bloc. Plus, more of an interview with the Palestinian Prime Minister, who says the Palestinian Authority is working with U.S. officials on a plan to run Gaza after the war is over. So good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in an exclusive interview, the Palestinian Prime Minister has told us the Palestinian Authority is working with U.S. officials on a plan to run Gaza after the war with major international help. Mohammed Shtayyeh also says Israel's goal of eliminating Hamas is unrealistic, and he hopes the militant group will instead join as a junior partner in a new governing structure. Well, he spoke to Bloomberg's Ethan Broner.
We tried 4 times or more to come to an agreement with Hamas.
And it didn't work.
And correct. And we signed 4 agreements. Unfortunately, none of them was ever implemented.
By them?
By them. And recently we have had a dialogue in Egypt and Al Alamein, and we agreed on certain issues. We did disagree on a number of issues, and we did form a committee to keep them engaged. That was the idea. But unfortunately, all these sort of things has happened, and then now things are going in a totally different direction. Now, for Israel to say that they are going to eradicate or eliminate Hamas, I don't think that's a possible goal to achieve, simply because Hamas is not in Gaza only. Hamas is in Lebanon, Hamas in leadership, everybody knows, in Qatar, and they are here in the West Bank, and so on and so forth. So what is needed really is a situation in which that Palestinian unity should be allowed to function on very clear points and agenda. We did put together certain points for Hamas to accept. They never accepted, including recognition of international legitimacy, United Nations resolutions, PLO commitments, and so on and so forth. We even invited Hamas to become part of the Palestine Liberation Organization. They never wanted to. Hamas wanted to take things their own way, either their way or the highway, and it seems that we are on the highway. So that is where the situation is. Now, as I said, whether Israel will be able to achieve what they are claiming to do, I doubt that.
But on the other hand, and in no way to say that you are in favor of what's happening, the suppression of Hamas ultimately needs to happen in some way. If they're not going to come into the PLO, if they're not going to forswear their armed struggle and join in some international legitimacy, what needs to happen with Hamas? What can you see happening?
Well, I think Hamas before October 7 is one thing, and Hamas after is another.
That's a very good point. And so?
And therefore, I think if they are ready to come to ground, to an agreement, and really accept the political platform of the PLO, accept the tools of struggle, because this is an important point of difference between us and them. and then there will be a room for talk. Otherwise, it's just simply things will continue to be the same, and even Palestinians should not be divided. We have been divided, unfortunately. Hamas took over Gaza by force in 2007, and this should not have lasted for 17 years. But obviously they were enjoying it there, and they were enjoying some sort of political safety net, funding, other issues that has kept them for 17 years, including the strategy of the Prime Minister of the State of Israel, because we knew and we know that Netanyahu's strategy was to keep Gaza totally away from the rest of the Palestinian territory in an attempt to kill every possibility of a Palestinian state. Netanyahu wanted to keep Gaza away, and he gradually or incrementally started to annex certain parts of the West Bank. Jerusalem has been put under wall, surrounded with a wall. The city of Hebron is divided between H1 and H2. The rest of the West Bank is fragmented between area A, area B. All this design has been there to achieve one single goal that the Prime Minister of Israel wanted, which is to kill every possibility of a two-state solution. I think, my dear friend, your audience should know that the Palestinian people are under military occupation. The American public maybe and the international public don't know that. We have been under direct military occupation since 1967. And Palestinians have been engaged with Israel peacefully through negotiation to try to end this. And Israel never wanted that. On the contrary, Israel was manifesting its occupation through colonization program, building more settlements. Today you have 755,000 Jewish settlers who are living here illegally. Thanks, United States recently decided to cancel any waiver for visa of settlers who are here. I think this measure should apply to all settlers, not only those who are engaged in terrorist acts against the Palestinians.
Mohammed Shtayyeh, there, the Palestinian Prime Minister, speaking exclusively to our Ethan Broner. Now, let's discuss the ongoing geopolitical tensions with Tina Fordham, founder and geopolitical strategist at Fordham Global Insights. Tina, as always, thank you so much for coming on. I mean, we're going beyond tensions. I mean, these are two wars ongoing, and end in sight for either of them.
I think your interview with the Palestinian Prime Minister was quite enlightening about the position of the government and the difficulty of incorporating Hamas, on the one hand, into a political solution, as well as the weakness, frankly, of the United States in constraining Israel. I mean, so the short answer is, and how I'm advising my investor clients, is to prepare for two long-standing global conflicts. This is already the longest war that Israel has been involved in since 1948.
But I feel, and I was at COP where, the Vice President Kamala Harris came, and it was the first time that she asked, actually, Israel to be more restrained. Is there a shift?
There are efforts going on behind the scenes that I think are very well understood. The remarks from U.S. Defense Secretary Lloyd Austin were quite a change in trend in terms of the advice. And I think President Biden's comments, earlier on in the crisis, don't make the mistake that the U.S. made in Afghanistan. This advice is not heeded, and I think we need to see this as part of the wider trend of the end of the Pax Americana and U.S. influence.
Is there anyone that Israel would listen to?
Well, I think that Israel, the Netanyahu government has a wider goal in mind, which is to eradicate Hamas. But I think that any conflicts involving terrorist movements and kind of revolutionary movements like Hamas are unlikely to be concluded at the negotiating table. And you can see the Secretary General of the United Nations invoking Article 99. Yeah. This could get worse before it gets better.
The Prime Minister of Israel was also warning Lebanon to not get involved. There are concerns that Iran could be more involved than we initially thought, although that's not verified. Do you see this widening?
Well, the U.S. has moved 2 carriers to the Med. There were Iran-backed Houthi rebel attacks on some U.S. positions. And so below radar or below threshold kinds of military attacks seem likely. Iran has made clear it doesn't want to enter the war, but Iran is playing a spoiler kind of role in both the Middle East conflict and with Russia and Ukraine, and we heard this in Putin's remarks.
I mean, how much more complicated has it become for Ukraine, given the lack of funding or the hesitance of the U.S. to put more money in Ukraine?
I think that the Ukrainian authorities understand that that they're in a very difficult position, and I also think that kind of Putin's newfound global role as he's been traveling to the UAE and meeting in the Middle East reflects the fact that he thinks the momentum is on his side. It'll be up to the U.S. Congress to put an end to that. I'm not sure.
Yeah. So when you look at your research, it's easy to read, it's smart, it's sharp. So we made a wall looking at some of the global insights and some of the hot spots that you see going forward. So we'll put that up, and at the same time, I'm going to ask you what everything changes if President Trump becomes President Trump again. So
yes.
how do you? I imagine you get a lot of questions from your clientele about that. Like, what's your answer?
Well, you can see in the sell-side investment research outlooks that are coming out that they're really sticking to inflation forecasts and interest rates. For this, we have data sets, and almost all of them refer kind of obliquely to geopolitical risk. So we try to pick up where they leave off, but there have never been so many potentially systemic factors in the mix, as well as the kind of reverberations with domestic political considerations like immigration and green policies, right? So U.S. anti-immigration sentiment in Congress and indeed within the public, now interfering with continuing U.S. support for Ukraine. This is a very acute set of geopolitical considerations. Market's still pretty sanguine.
So again, I mean, this is all about divisions, right? Within countries that could get worse and spill over. We have the Taiwanese elections. When you look at your list of worries, where does that show up?
At the moment, it's about in the middle because we're trying to
There's so much else.
Yes, we've still put the Middle East escalation risk and Ukraine escalation risk at the top. Taiwan elections mid-January could be a thorn in the side to China. I was in Asia at the time of the APEC summit talking to investors there who kind of swiftly moved with enthusiasm toward risk on, and better relations. I think the improved mood music between the U.S. and China is a shift in tactics, not strategy.
But, I do find it amazing. Like, if you look at global GDP, I think 60% of people or 60% of countries that make up global GDP will vote next year. I mean, 2024 is a big year.
It's really astonishing. I mean, 4 billion people will vote in the most populous democracies. So India, South Africa, Mexico, which had huge protests. Of course, the United States. The reason why I call the outlook inflection point is because just how much about, let's say, the second half of this decade depends on these choices. These aren't incremental moves. They're going to be quite significant. I think investors have got their heads around the idea that there could be a Trump 2.0. U.S. investors have good memories of Trump presidency. In Europe and Asia and in the Middle East, it's a very different sense.
Thank you, Tina. Tina Fordham, their founder and geopolitical strategist at Fordham Global Foresight. Now, coming up, German Finance Minister Christian Lindner returns to Berlin after those EU fiscal talks, but it's not much easier on home soil as the German budget negotiations continue. We discuss that next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, German Finance Minister Christian Lindner says he expects agreement on the government's revised 2024 budget in a couple of days, but it's unlikely to pass through Parliament before the end of the year. Well, for more, let's get straight to Oliver Crook, Bloomberg's Germany correspondent in Berlin. Ollie, so good to have you on the program. So what exactly is the latest on this German budget drama?
Yeah, so the ambition was to get this done and dusted in 2023 and really leave it behind it. But now that plan seems to be dead in the water. And what basically needs to happen is it still needs to be reviewed by the Parliament and has to go through the Parliament. That basically is not going to happen, according to Lindner, according to the SPD. And the issue that you've got now is that this is going to drag into 2024, which is a problem politically for this coalition, right? They may be able to agree on their own level, but they really wanted to put this behind them. And that is just not going to happen right now. So they're still trying to plug that 17 billion euro hole within the budget. And there are really only two ways of doing that, right? You have to cut spending and cut subsidies, or you need to raise revenue from the government. That is higher taxes. That's a red line for the FDP. There is a sort of way you can cheat that, which is the third option, which is what has happened in the prior few years here. Every time there's been a crisis, which is suspending the debt brake. That obviously is at the center of the issues that this government has had. However, could they possibly suspend the debt brake partially for certain initiatives like the subsidies and the money that they're going to give to Ukraine? That's 8 billion euros. That could go a long way. But again, politically, this is a massive issue. The government is not doing well in the polls. And really, the task for them will be coming out and saying that none of these coalition partners are the biggest losers for what is undoubtedly a big losing battle for this government.
Later this morning, the Chancellor, Olaf Scholz's own party's conference also begins in Berlin. So what are we expecting from the SPD?
Yeah, and Francine, this has been completely hijacked, obviously, by this budget situation. And really what they're going to do is they do this every 2 years. So this is actually the last one that they're going to have before the 2025 election, the national election here in Germany. So really they need to set out their agenda and say what their priorities are going to be. For the SPD, those priorities are going to be spending more money on the sort of social initiatives that the SPD cares about, but also greening the economy and also modernizing the economy. How do they intend to pay for that is the question. One of the ways they intend to pay for it is to tax the sort of mega wealthy. That is probably going to be part of it. But part of it, again, comes back to the central issue, the debt brake. They want to suspend the debt brake. To the SPD and to the Greens as well, there is one thing that is standing between Germany and a modern green economy of the future, and that is the debt brake.
Oliver, thanks so much. Oliver Crook there in Berlin. Coming up, from the house of Hermes to Gulf Royals, we'll bring you Bloomberg's annual global ranking of family fortunes next. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Move over, Waltons. Another family has emerged as the richest dynasty in the world. Now, for the first time, the House of Nahyan has joined Bloomberg's annual ranking of family fortunes and done so at the very top. With the $305 billion fortune, the Al Nahyans of Abu Dhabi top the Waltons of Walmart by a cool $45 billion. Now, another new entrant, the Al Thanis, the royal family of Qatar, at number 5. So let's get into number 3 on the list, and that's Hermes. Bloomberg's Angelina Rasquet joins us from Paris with the latest. Angelina, first of all, good morning. Can you tell us what's behind the Hermes success, especially since 2010 when LVMH attempted to buy the company?
Indeed, in 2010, LVMH tried to built a stake, and that really shocked the family. It was already a family-controlled business, but following this stealth, stake purchase, they boosted their control over the company even more. And nowadays, Hermes is one of the few luxury companies that's still independent. And since that moment, the stock price of Hermes has risen by more than 1,000%, surpassing the performance of LVMH. And currently, it's led by the 6th generation of heirs. So really, it's been a phenomenal success.
Yeah, and it's amazing. Like, every time you speak to a luxury CEO, they say, Hermes is really the gold standard. So how are they so different to peers? Is it that they sell more or they sell more expensive? Were they able to increase prices?
Yes, indeed. Basically, it's the crown jewel of the market, and it's largely derived due to their supply-constrained model based on artisanship. Basically, demand for its leather goods, in particular, think about a Birkin or Kelly bag, constantly surpasses its output capacity. So Hermès is constantly having to update the markets about leather good openings in France. It has a goal to increase output by about 7%. But still doesn't, it doesn't manage to keep up with demand. So basically, there's also a juicy resale market. So it's got a lot of pricing power, which is very important in the luxury space. But also, it does things differently because, for instance, all the luxury brands out there, they rely on brand ambassadors, on celebrities, on influencers. You think about Gucci, they recently had a campaign with Kendall Jenner. You think about Chanel, they have Timothée Chalamet or Kristen Stewart. At Hermès, you don't see any famous face promoting their fragrances, their silk scarves, or their bags. So that's really peculiar. And when it comes to the artisanship, I mean, going back to that model, they also want one artisan to do one bag by himself. So for instance, for a Kelly bag, it'll take about 20 hours, and they really insist that only one artisan will do it. So really, all in all, a very peculiar way of doing luxury.
Yeah, peculiar way, but that really works. I'm looking at, the luxury sector. It's by far the best performer, 35% gain for its shares. For example, LVMH is only 5% higher, and Gucci or, LVMH is up 5%, and then Kering, which owns Gucci, is actually down. So what's the outlook for 2024?
Exactly. I mean, we've already seen a slowdown this year, and so far what we've seen is that Hermès has been the most resilient. For 2024, Bain put out a report last month, and they expect, in their base case scenario, they expect the market to grow between 1% and 4%. So that's a slowdown from the 8% that we saw this year. Obviously, not all brands are equal, and some will fare better than others. And it's possible, if you're looking at the track record of Hermès, that they'll probably be more resilient, thanks to, again, this image of exclusivity and scarcity. But some analysts already consider that it's too expensive. For instance, Morningstar has a sell rating because it considered that it's too expensive, considered to future earnings, relative to future earnings.
Angelina, thank you so much. Angelina Rasquet there with the very latest, of course, on Hermès. We put together a list of some of the most fortunate, or the family, of course, dynasties with the most fortunes out there. Now, moments ago, we found out that Nadia Calvino has been picked by EU finance ministers for the top EIB jobs. We'll have plenty more on that throughout the day. We, of course, have U.S. jobs, so full roundup of what we can expect. That's coming up next. We also look into next week. The big one there will be BOJ. Stocks steady but nervy as they await U.S. jobs data. This is Bloomberg.